A very good morning and warm welcome to everyone who's joining us this morning. A quick introduction from our end. My name is Swapnil Pillai, and I'm the Associate Director for Research within Savills in the Middle East. I have more than 14 years of research experience across the Middle Eastern and Asian markets. And I'm joined this morning by the co-author of the Oman Property Report and Head of Strategic Consultancy for Savills in Oman, Mr. Matthew Wright. Matthew, welcome and good morning to you.
Good morning, Swat. Good morning, all. Looking forward to going through the report and having a greater understanding of what's going on in the real estate sector in Oman.
Thank you very much, Matthew. So over the next 45 minutes or so, we will be discussing the findings from the Oman Property Report and also followed up with a quick Q&A session post the presentation by Matthew. But before we delve into the real estate dynamics in Oman, I want to quickly go through real estate trends as well as socio-economic situations across the Middle Eastern market, just to set the scene for what's happening in Oman. So without further ado, let's quickly jump right into it. Now, over the last 2 years, the real estate sector has been operating against the backdrop of a challenging macroeconomic condition, both globally as well as locally. Now, in 2020, the global economy came to a standstill because of the challenges and supply chain disruptions brought about by the pandemic. And as we and the local and the global economies were gradually starting to recover from the impacts of the lockdown-related measures, the global economy was again brought to a standstill because of the Russia-Ukraine crisis. Now, as per the recent IMF estimates, the world GDP is projected to grow by only 3.2% in 2022 and is likely to further slow down in 2023, growing by only 2.7%. Now, most of the emerging economies, especially in Asia Pacific, are also likely to witness a slowdown. And BRIC nations, which includes your Brazil, Russia, India, and China, which have essentially been the growth drivers for economy over the last 10 decades, are likely to grow by only 3.5% on average between 2023 and 2026. Now, while there is a lot of gloom and doom across the global economy, the Middle East is somewhat positioning itself as a bit of a bright spot in this economic downturn. Now, as per recent IMF estimates, the Middle Eastern countries, as well as other oil exporting nations, are likely to witness a $1 trillion windfall due to the higher oil prices, which are averaging around $92 per barrel for 2022. Now, Saudi Arabia and UAE are among the key economies in the region which have benefited from this trend. And both these economies are likely to grow by around 8% and 7% respectively in 2022 and are still likely to witness a healthy gradual increase in their economic output over the next few years. Now, the biggest beneficiary of the supply chain disruptions and increase in commodity prices has been the Saudi Arabian government. The government recently released its report, which said that the economy is on track to witness a $24 billion worth of surplus in budgetary surplus in 2022, and is likely to witness a further $2.4 billion of budgetary surplus in 2023. We are witnessing similar trends across UAE and other Middle Eastern markets as well, and Matt will touch upon what we are seeing in Oman. Now, with all this budgetary surplus, the UAE government as well as the Saudi Arabian government have been well positioned to continue their diversification plans and cushion their economies from any major supply chain or economic shocks that might arise in the future. Now, as such, the Middle Eastern countries are positioned themselves as one of the biggest construction markets globally, with more than $1.4 trillion worth of construction projects either in the design phase or under construction across the region. Again, Saudi Arabia is leading this trend with close to $820 billion worth of construction projects, of which more than $700 billion is concentrated purely across the giga projects, namely Red Sea Development, Qiddiya, Roshan, Neom, etc. So as the supply chain disruptions and increase in commodity prices have led to windfall in oil revenues for the region, The pandemic has also had, to a certain extent, a positive impact on the region because it has helped to showcase the resilience of the local government and the superior infrastructure quality compared to some of the European and North American counterparts. As such, the governments kind of piggyback on the slowdown in economy to make sure that they are implementing progressive policy changes to ensure a quick turnaround of their economy and opening up of the local markets sooner than some of the global counterparts. The governments in the local markets, especially in UAE, Bahrain, and Saudi Arabia, and not Saudi Arabia, Oman, introduced something called as the Golden Visa, which led to a strong increase in demand for residential transactions by both residents as well as non-residents who kind of looked at the region from a longer term perspective. As such, you can see the graph on the slide right now, which shows that in Dubai, the total residential transactions kind of increased to 56,000 units in 2021, which was an increase of almost 73% year on year. And in 2022, so far, we have already witnessed close to 62,000 residential transactions. Assuming that we witness another 5,000 average transaction month on month for the next three months, we will be witnessing close to 35% increase in residential transactions on an annual basis, which is the highest residential transaction recorded across the Dubai market. Now, this is a similar trend that we have seen in Abu Dhabi and Sharjah as well, wherein both the markets have seen strong increase in demand for their residential properties. A similar trend was kind of echoed in Bahrain, wherein real estate transactions increased by almost 46% to record $2.6 billion worth of transaction in 2021. And Matt can probably touch upon the Oman market, wherein we have also seen some positive offshoots of the implementation of the Golden Visa regime. Now, while there has been a strong increase in residential transactions and the outlook for the region generally looks quite optimistic. But having said that, we're still operating under a highly uncertain economic landscape, one which is currently dominated by high interest rates. And we are seeing the effects of high interest rates kind of drill down into some of the other global markets. In the US, for example, residential transactions have started to slow down. In UK, the prime capital as well as rental values have started to slow down as well. But having said that, the Middle Eastern market still seems and looks like it is well cushioned from some of the other global markets, and we might not see a drastic drop or correction in asset prices that we have seen during the 2008 financial crisis. And the one big factor for this is the progressive policy measures that the government have been implementing over the last few years. The Golden Visa is one such regime, but the government has also made sure that they are liberalizing their foreign direct investment policies. They're making sure that residency is becoming a lot more accessible to not just people with direct employment, but also for the gig economy. They're making sure that they're moving into some of these new sectors such as fintech, tech, the metaverse. So Dubai was the first city in the world to kind of host the metaverse conference. So all these factors kind of position the Middle East and some cities in the Middle East in really, really good position to kind of make sure that they're getting out of this economic turmoil in a more systematic manner without any dramatic disruptions to their economy as well as to their real estate sector. Now we will look at what we are seeing in the Oman property market, and I'd like to call upon Matt to kind of run us through the presentation. Matt, over to you.
Hi, Swapnil. Sorry, it's getting the... Okay. Right. So thank you, Swapnil, for that overview as to what's going on in the wider region. And now we'll take a sort of a more comprehensive look at what's going on in Oman. So we'll look at what's happening in terms of macroeconomics. We'll then look at the office rental market, and then take a look at the residential rental market. So in terms of macroeconomics, despite the pandemic, really, Oman is now in a really strong fiscal position. So it's an economy that's still reliant to a significant degree on the hydrocarbon sector. And with oil having hit historic lows of just over $25 a barrel in mid-2020, now we've seen, as the graph shows, a very strong increase in the value of oil, with oil prices breaching the $100 per barrel mark in May this year. And it stayed up there ever since then. So in addition to that, also, you can see that Oman's oil production has gone up by almost 30% from mid-2020, when it was $850,000 a barrel. And now Oman is producing $1.1 million a barrel. So with both of these factors, higher oil prices and increased production, Oman is now in a much stronger fiscal position than it was perhaps a year ago. Next slide, please, Swapna. And that also reflects in terms of what's happening in terms of government finances. So these are very much on the upturn as a result of both higher oil values or higher hydrocarbon values and a very prudent fiscal approach. So in Oman's budget for this year, it was projecting a deficit of 1.6 billion, which is much smaller than previous years. But by the end of August, the budget was actually in surplus by 1.1 billion, with public incomes rising by almost 50% in comparison to the same period last year. And as a result, the ratings agencies are seeing a much more positive outlook for Oman in terms of its fiscal position. So a recent report by Standard & Poor's stated that the Omani government has continued to reduce reliance on oil receipts and improve fiscal sustainability in line with its medium-term fiscal plan to 2025. And this ratings agency estimates that Oman will actually achieve a fiscal surplus of about 7% of GDP for 2022. The IMF also recently announced that high oil prices, continued fiscal consolidation under the authority's medium-term fiscal plan, and determined implementation of structural reforms are expected to generate fiscal and external surpluses and support higher growth over the medium term. So, as highlighted in our report, the government's strengthening financial position has resulted in the introduction of several larger scale projects over the last 18 months. And this is very much sort of helping to drive the economy onwards. Next slide, please, Swapna. So this is very strongly, what's been happening in terms of oil prices is very strongly reflected in terms of what's happening in terms of gross domestic product. So the impacts have been really that the hydrocarbon sector contribution to GDP increased by 75% in the first half of this year in comparison to the same period last year. And in the first half of this year, it contributed approximately 40% of Oman's gross domestic product. But other sectors have also seen some significant gains. It hasn't only been the hydrocarbon sector. So manufacturing has grown by almost 70% this year, while two other sectors which have seen notable growth of around 25% are the transportation and storage sector and the accommodation and food services sector. The overall result is that Oman the IMF is projecting that at current prices, Oman's GDP will grow by over 25% this year, and then settle into a more steady growth pattern up to 2027. So essentially, despite the impacts of the pandemic, the Sultanate's economy is now actually in a much stronger position than it has been for over a decade. Next slide, please, Swapna. As you can see from the chart, oil is highly volatile, and the only slight headwind that we'd note in economic terms is that the World Bank is currently projecting that oil prices will see a slight decline over the next 2 years. But we also know that that these values are still high values and significantly above the government's fiscal break-even position in its current budget. Next slide, please, Swapnil. And then we come to demographics, and we're all, I think, fully aware as to the impacts of the pandemic on the population. So, in terms of the Omani population, that's grown steadily at around 3% per year over the last decade or so. But the expat population actually, it hit a peak of 2.1 million in 2016, but then started to see a gradual slide before COVID hit in 2020, and there was a rapid decline in 2020 and 2021, with the expat population dropping to 1.7 million in 2021, which is a reduction of around 17.5% in comparison to 2016. But the good news is that with the economy improving, there's been a really rapid resurgence in the number of expatriates in the Sultanate, with the expat population climbing to almost, well, to around 2 million by the end of the third quarter of this year. And this is encouraging because the growth of the expat population is a strong sign of an economy that's functioning well. Next slide, please, Swapnil. So in terms of an outlook and positives and perhaps challenges, obviously high oil prices and increasing oil production are great positives in terms of the Sultanate's incomes. And that's resulting in extremely strong recovery in gross domestic product in 2022. It's also resulting in rising government incomes, which is resulting in a budget surplus and also reducing the government's debt. And we're also seeing, obviously that the expatriate population is continuing to grow, while the first half of this year also saw a strong recovery in inbound tourism as travel restrictions were eased. And this is, good news for the hospitality and tourism sectors in the Sultanate. In terms of challenges ahead, one, there's obviously, as Swapnil has pointed out, there are some quite significant economic headwinds around the world at the moment, whose impacts are difficult to predict. And as we've noted, there's the potential for some moderate reductions in oil values over the next couple of years. But overall, the real estate market has been through a tough few years, and I think the market conditions will remain challenging. But as we'll see, there are some signs of improvement happening. Next slide, please, Swapnil. Great. So now what we'll do is take a quick look at the office rental market. In reality, there haven't been any really significant changes in the office rental market this year. Demand has remained relatively moderate relative to what is an ongoing growth in supply of office space in Muscat. And the result really is that a lot of buildings are struggling to achieve higher levels of occupancy. And we also note in our experiences is that demand really remains from companies with an existing presence in the Sultanate rather than new entrants to the market. In terms of what tenants are looking for, car parking as always remains a key issue, but we're also seeing a greater focus from tenants on the quality of the building and the amenities that it provides. Rental values have seen a relatively limited reduction this year, and there's perhaps been a greater focus by landlords on offering improved rental incentives to both attract and retain tenants. As a result, current average rental values are approximately around 4 to 6.5 riyals per square meter per month for larger shell and core spaces, and around 5 to 7.5 riyals per square meter for smaller, fully finished spaces. what the trend we're noticing is that with rental values sort of at lower levels and relatively compressed, is actually the cost of fit outs that's probably the major factor that tenants consider when they're looking at acquiring new space. So overall, I think that the market conditions will remain challenging this year from a landlord, or for the next 12 months from a landlord perspective. But the plus side is very much that with more buoyant economic conditions, that this should have a positive impact on the rental market in terms of demand. While we'd also not really expect to see any further significant or notable drops in rental values. Next slide, please, Swapnil. So in terms of where we see the office market going, well, there's as we said, there's a growing oversupply relative to actual demand. So a supply-demand imbalance. Demand and uptake essentially to remain relatively muted, but with the potential for increased demand as the economy continues to expand. There'll be an ongoing requirement for rental incentives. The landlords have to be very proactive to secure tenants. Well, there'll be a growing tenant focus on parking and how the property is managed. The demand we foresee will still remain primarily for companies within Oman, but with the economy growing, that could be a stimulus for new entrants to the market. There are likely to be continued pressures on rental values, but we wouldn't foresee it that at current levels and in current market conditions that there are likely to be any further significant drops in rental values. And there's also the potential to adapt vacant space to sort of emerging market requirements post-COVID. Great. Swap the next slide, please. So take a quick look at the residential market, and we'll start off in terms of what's happening in terms of the population. So having dropped to 0.75 million in 2021 from a high of just under 1 million under 1 million in 2016, this year has seen a really strong recovery in the expatriate population. And that's rebounded almost to pre-pandemic levels. Now, the vast majority of this population growth has been driven by labourers rather than professionals, and it's the professionals that really drive the residential rental market. But there still has been a growth in the number of expat professionals, which has improved market conditions in terms of the sort of demand and supply balance. And current evidence is that this is a trend that's likely to continue over the coming 12 months. The one slight concern is I think with a growing focus on Omanization, that perhaps some expatriates are a little concerned as to long-term job security and are then perhaps more reluctant to spend money on higher rental values. Next slide, please, Swapnil. So in terms of how that's had an impact on rental values, rental values, as the graph shows, have been under pressure since 2015. And this was exacerbated obviously by the impacts of the pandemic. So what we saw was a drop in our average rents of around 20% from 2019 to 2021. But this year has seen, with the growing population, it's seen perhaps greater stability in the market, with rental values sort of settling down with very limited further drops. And notably that at Al Mouj, rental values have stabilized to a significant degree. As you'll see from the graph, the drops in rental values over recent years, we've seen the sort of rental band range between the top and the bottom narrow quite significantly. And for mid-range to higher end two-bed apartments, that band is approximately sort of from 250 riyals to 500 riyals per month. So current evidence is that we are nearing, or we're at the bottom of the market in terms of rental values, while the growing expat population will perhaps help to add further stability to the sector. And even we could start to see growth in a limited number of locations over the coming year. Next slide, please, Swapna. So the villas have been a slightly different story to apartments in terms of villas in more favoured locations such as Al Mouj, Muscat Hills and Shashi Al Quram have generally seen a much more resilient performance over recent years due to there being a relatively limited supply in comparison to demand. The average value of a 4-bedroom villa has dropped by around 20% across Muscat since 2019, with perhaps Quram, Madinat Sultan Qaboos and Bausha seeing the most notable declines. In contrast, however, as you see from the graph, average rental values for villas and townhouses in Al Mouj have actually saw relatively limited declines over this period. And this year has seen rental values starting to nudge upwards. And this is a simple supply and demand, that there are a relatively limited number of villas and townhouses at Al Mouj, but it's really become a sort of go-to residential destination. So demand is really outstripping supply. Shashi Al Quram and Muscat Hills have also seen a stronger performance than the market average. The wider variance in performance in comparison to residential apartments has meant that the rental range between the top and the bottom values has actually grown over recent years. And the values for mid-range to higher-end 4-bedroom villas across Muscat are now sort of ranging from 500 riyals a month to around 1,500 riyals a month. Yes, with apartments, we really see that we're now at or near the bottom of the market, that we're unlikely to see any further significant drops in rental values, while as Al Mouj shows that some locations are actually starting to see moderate increases in rental values. So a much brighter picture for the residential market in terms of rental values in comparison to perhaps to last year. Next slide, please, Swapna. So in terms of where we see things going, overall, the construction has been ongoing over, even during the pandemic, and demand is generally relatively limited to overall supply, but perhaps with the higher quality projects, that demand supply balance is evening out. As a result, we would see really that there are limited further rental value reductions, but the rental budgets, tenant rental budgets, will generally remain moderate. Or we're seeing a greater focus, I think, as a result of the pandemic, on villas with large private garden spaces and offering swimming pools. There's been a very strong focus on demand at Al Mouj. It really has become, for many people, the go-to destination when they first come to Oman. And there's obviously, this is a trend that started already, but we see the potential over the coming 12 months for moderate rental increases for villas and townhouses at both Al Mouj and perhaps Muscat Hills. Another feature is, good facilities and parking really are a prerequisite for apartments these days with so much choice. Thanks, Swapna. Can I have the next slide, please? Well, before we move on to questions, I'll just summarize what we've gone through. So in summary, the broad trends that we'd identify are that economic conditions in the Sultanate are much brighter than they have been for several years, which is always a positive, and that feeds into the real estate sector. So both the residential and office markets are perhaps showing greater stability, greater predictability, they're both, we'd assess, nearing the bottom of the market. And while I don't think there are signs there's going to be significant growth, there are locations where we would expect to see growth over the coming year. So overall market conditions will remain challenging, and we're far from out of the woods yet as the real estate sector. But overall, the picture is a lot brighter than we would have expected perhaps 12 months ago. So that summarizes the Savills' view of the Oman market. And I'll now hand back to Swapnil so that we can take some questions from the audience.
Thank you very much for that, Matthew. As always, very, very detailed. We do have a few questions that we have received as part of the registration. And I think the one that kind of relates to what you mentioned about the overall economy and the growth of expatriate population is, are you seeing the real estate and the construction sector to be a driving factor for the economy in Oman, or is that the other way around?
Yeah, we definitely see the real estate growth in the real estate sector is as a result of economic growth. It is not a driver for it. And so the fact that the economic conditions are so much better than they have been for several years is a big positive for the real estate sector. It could take some time to really feed in, but there are certainly more government projects being proposed and underway, more money flowing into the construction sector through that. So overall, we'd say that the outlook is pretty positive. But in reality, the real estate sector is driven by the economy rather than the other way around.
Fair enough, Matt.
So one of the questions is, why has the Dubai residential rental market seen such a strong recovery over the last 18 months?
Right. I think before I jump into the specifics of Dubai market, I want to draw the attention of our audience to a recent Savills report called the Savills Resilient Cities Index report. This is a report that we released as part of our impacts publication. And as part of the report, we looked at 200 global cities and ranked them across 4 parameters. One is the relative strength of the real estate investments that happen across these cities, the economic strength and depth of these cities. Then we looked at the ESG parameters and rankings of these cities. And then we also looked at the depth and spread of the tech and tech-related companies across these cities. Now, unfortunately, none of the Middle Eastern cities featured in the top 10 list. But if I was to do a regional comparison, then I'm pretty sure that Dubai would probably rank among the top 3 most resilient markets in the region. Now, there are a couple of factors that kind of lead to this. One is the economy is very, very well diversified. Less than 2% of Dubai government's GDP derives from the oil and gas sector. The economy has grown by almost 6% year on year in 2022. That is the projection. Then the government has been very proactive in releasing policy measures which are, promoting and continuing to diversify the economy. The recent one being something called as the Next Gen FDI, which is aimed at purely targeting the tech and fintech related companies. And the government has already managed to convince around 40 companies to either relocate their headquarters to UAE, and Dubai and Abu Dhabi are definitely going to benefit from that. Or some of these companies are looking at expanding their presence in the region. Now, with all these positive economic sentiments, and if you look at the real estate prices in Dubai compared to some of the other global gateway cities like London, Hong Kong, New York, it is still relatively very low. So I think we also released a report called as the Savills Prime Residential Index, and Dubai ranks among the the bottom 3 in terms of the per square feet rate that it offers. So you have a really strong and diversified economy. You have an economy which bounced back relatively quickly compared to some of the other global cities. You have a strong and progressive government policy. And all these factors have led to a strong demand for residential properties across the city. In 2022, compared to 2019, we have seen 124,000 new residents move into the city. And all these residents are then kind of driving demand for residential and rental properties. So on an annual basis, we have seen rents go up by almost 20% across some of the prime developments, on an average around 10 to 15% across the villa and apartment communities. Now that is in terms of Dubai. Now in terms of Muscat, Matt, what are some of the important factors that landlords should consider to attract and retain some of the tenants that they have across the residential segment?
Yeah, from a landlord perspective, it's really about being competitive. So we'd identify perhaps, four, or our experiences, there are, perhaps four main things as a landlord that you need to address. And the first and perhaps most important is pricing. Is what you're asking, is that in line with the market? Is that in line with tenants' expectations? So it's really important that, you don't overprice your property. It's also important you don't undervalue it. But so you need to ask people, you need to keep abreast of what's going on in the market, what similar properties are going for, and make sure that your property is competitive. Another really important factor is presentation. How your property looks and feels is extremely important when showing a potential tenant. So it should be clean. It should look in a good state of repair. If you are going to make modifications or improvements, then as a landlord, you should do that before you put the property on the market. It's very difficult to make a tenant imagine what the property is going to be like, rather than being able to actually experience what the property is going to offer. So it's just a basic human thing that people react instantly when they go into a property, and if the first impression is good, they'll be interested. If the first impression is bad, you've got a lot of hard work to do to catch up on that. Then, landlords also need to be adaptable, and what I mean by that is that they need to react to, if they're getting comments back from their agents, their tenants, highlighting various issues, then you really need to address these. And also, if there are movements in the market price, then you should also adjust your price accordingly, whether that's upwards or downwards. And then finally, management. That everyone wants to live in somewhere where they feel it's going to be looked after. They're going to be looked after, and that any problems and issues are going to be dealt with quickly and effectively. So those are really the four main factors that we'd see for residential property. They spill over into other sectors, but price it right, present it properly, and move with the market.
Completely agree with you, Matt, on that. I think especially with the fact that a lot of people are spending a lot more time working from home and doing hybrid working, there's a lot more priority on how and where they live. So yeah, making sure that those four parameters that you mentioned are kind of it becomes very important.
No, absolutely, and it's a highly competitive market. There's a lot of supply out there. There's a lot of competition, and so you really need to make your property stand out from the others as best you can. So we had a question, which is for other countries in the GCC experiencing challenging office rental market conditions. Are there any notable tactics that you've seen in terms of how landlords have adapted? Tactics that landlords have adopted in order to secure new tenants?
Thanks for that, Matt. So I think, again, it's important to kind of highlight that though at the start of 2020, the dynamics across the region were pretty much consistent, wherein we were seeing a slowdown in demand. A lot of corporates were still thinking about their real estate footprint and deciding whether they should commit more space or they should cut down more space. So there was a bit of a conundrum back then. But having said that, fast forward, the Dubai commercial market, for example, has done phenomenally well. Most of our grade A commercial assets are operating at 90% plus occupancy levels. We have seen rental increases in the range of 15 to 20% across some grade A developments. And this has also been due to, again, the fact that the government has been quite proactive in getting new sectors. And so in the UAE, for example, they've come up with a new cryptocurrency licensing, wherein there are certain zones in the city wherein the crypto companies dealing with crypto assets can take up space, and that has led to a strong demand for a certain asset classes. So in Dubai, probably before the pandemic and during the pandemic, we could see a lot more lease incentives being offered by landlords. Most of them kept their face rental values the same, but they would then offer a 6-month rent-free period, would contribute to the fit outs of some of these properties, and then also offer a shorter lease length so that companies could decide as and when the economic situation changes. But in other parts, like in Bahrain, for example, we have seen that a lot of landlords have keenly adopted offering co-working spaces as part of their office portfolio, because we could see a lot more corporates shift and take up space across co-working as well as flexible office spaces. So it was a very good initiative for developers to kind of venture into that and offer a co-working space as part of their office portfolio. But in general, it has been keeping the face rent the same, but offering lease incentives in terms of additional car parks, in terms of extended rent-free periods, contribution to fit outs, etc. And then, sorry, again, just on that, there has also been a growing focus from companies on their environmental footprint. So a lot of developers have been looking at getting their building to a certain environmental or ESG specification, either getting them LEED certified or getting them certified as per the local parameters to meet some of the requirements of these global corporates. So that was office. Now, Matt, in terms of Muscat overall, if you look at the office sector as well as the residential sector, do you see we are out of the woods yet? And do you see there's an upward trajectory in the market going forward? What are your thoughts on the next 2 years?
I think it's too early to call an upturn in the market. But there are some green shoots emerging, particularly in the higher end residential sector. So while not perhaps saying being able to argue that the markets as a whole are moving upwards over the next 12 months, there's certainly overall conditions are more encouraging, and would expect the markets to show greater stability rather than further declines.
Perfect. Thank you very much for that, Matt. I think we have time for one last question, and we have received a few today so far. One question is more pertaining to the environmental aspects, talking about climate changes being a risk to the property itself. Are you seeing that kind of across the property markets in Oman, an impact of environmental related challenges on demand as well as supply?
And certainly, I actually experienced it personally when my villa flooded. So, we've experienced some pretty rough weather and some high rainfall this year. And, parts of, although the drainage system has been massively improved across Muscat, there are parts that still flood, during exceptional rainfall. So, there are risk areas, and certainly, with weather patterns appearing to change, particularly in terms of rainfall, those risks are perhaps becoming more evident. But to counter that, the government, is taking measures to address those risks and improve the drainage, which is already done to a significant degree. In terms of environmental focuses, I think that probably what we'll see is, with a greater focus on ESG from larger corporates, that there'll perhaps be a growing requirement for corporate space that it's an environmentally sensitive building, perhaps BREEAM or LEED certificated, and that could be part of their perhaps part of their global corporate governance. So certainly we'd see sustainability coming up the agenda over the coming months.
Perfect. Perfect. Thank you very much for that, Matthew. Unfortunately, we are out of time. We have received a few questions during the session, and please be rest assured that we will get back to all of these questions. They will be posted on our website and also emailed on the registered email address. The webinar is being recorded and it will be uploaded on our website soon as well. The Oman Property Report, as well as the other reports that I mentioned, are available on our websites. But if you would like to receive a copy as soon as we release any other reports in the future, please do get in touch with us and we'll make sure that you're included in our mailing list. We hope you enjoyed our presentation, and thank you very much for your time, and good luck for the rest of the day. Thank you.